When you think about long queues in a pump station, how do you think the feeling is? Frustrating, right? If you go back to history, one of the key factors contributing to strong world economic growth and low inflation in the post-World War II era was an abundance of cheap energy. The price of oil was only about $3 per barrel and gasoline at the pump was about $0.30 per gallon. However, you see, the world of cheap energy vanished quickly. The price of oil skyrocketed. Quadrupling of oil prices unleashed essentially a series of events that posed new challenges for industrial and developing countries. Now investors began to worry and question, was the shortage of oil likely to be temporary or long-term? Or what impact would higher oil prices have on the global economy and inflation? And how exactly would policymakers respond to it? These questions may arise in anyone's mind when the global economy is in crisis. Understanding the crisis helps us better prognosticate what is to come in nearby future. The year is 1973. War broke out between Israel and the Arab states. Members of the Organization of Petroleum Exporting Companies, commonly known as OPEC, imposed an embargo on oil exports that resulted in oil prices surging to $12 per barrel within a matter of months. You see, the embargo in the US came at a time when 85% of American workers drove to their places of employment each day, and gasoline lines snaked their way around the blocks. At this time, the price at the pump had risen from 30 cents a gallon to about $1.20 at the height of the crisis. So what exactly led to this kind of crisis? For that, we need to understand what was happening in the beginning of 1970. During the early 1970s, the world economy was expanding rapidly. Growth rates in the major industrial countries, which averaged around 4% per annum from 1960 to 1972, surged to around 5 to 6% in 1972 to 1973. Economic growth in the developing world was even faster. The rapid expansion resulted in a significant increase in global inflation. In 1973, inflation in the industrial countries averaged around 8%, while that in the developing world was around 12%. The evidence of global inflation was most visible in the commodity world, which surged by more than 60%. Prior to 1973, oil prices were increasing in line with world inflation. However, supply-demand conditions in world oil markets were tightening considerably as a result of increased US dependence on imported oil. The demand and rapid expansion in gasoline consumption was due to steady substitution by public utilities from coal to oil. At the same time, domestic oil production in the USA was peaking, and also during this time, the Nixon administration imposed price controls on domestically produced oil as part of its wage price controls program. As a result, the USA was becoming more dependent on imported oil. So, we can see after having been self-sufficient in the early 1950s, the USA was importing 35% of its energy needs in 1973, and the US petroleum reserves were nearly depleted. When OPEC responded to the US involvement in the Middle East war, governments, households and corporations were completely awestruck with what was to come. Economic fallout took place in several countries. Central banks had to tighten their monetary policies, which caused the aggregate demand to weaken even more. The Federal Reserve, for example, had boosted the federal fund rates from 4.5% in late 1972 to more than 10% by 1974, while the Bundesbank increased short-term rates by approximately the same amount during 1973. The Bank of Japan's short-term rates were even higher to 12.5% in 1974. Whether you know it or not, economists at the Council of Economic Advisors calculated the oil crisis caused declines in real gross domestic product, that is GDP, of 4.7% in the United States, 2.5% in Europe, and 7% in Japan respectively. During this time, this translated into what was then the most severe global recession in the post-war era. At the same time, the surge in oil prices created massive payment imbalances between oil importing and oil exporting countries on a scale that had never been imagined. The combined current account surplus of OPEC rose tenfold in 1974 to $67 billion, by far the largest imbalance on record at that time. Policymakers were unsure whether the international financial system would be up to the task of recycling funds from the oil exporters to the oil importing countries, especially those in the developing world. Unless this group of countries could be offered financial assistance to pay their higher import bills, there is no way they could be forced to curtail economic output even more than industrial countries. You see, many observers were fearful that the developing countries would have no option other than default on their external debt. That might have been a scary moment for people driving cars and businesses which depended on transportation system. But things went better than what most nations assumed to come as worst. You see, worries about the financial system abated in 1975 as oil prices stabilized and inflation rates in the industrial countries began to go down. The lessening in inflation enabled the Federal Reserve and other central banks to ease monetary policies. The Federal Reserve, for example, lowered the federal fund rates below 6% from more than 10% in 1974. Over the same period, the Bank of Japan reduced its discount rate to 6.5% from 9%, while the Bundesbank cut its discount rate in its half to 3.5%. The collective policy actions have set the stage for a recovery in industrial world in the second half of the year. At the same time, the huge payment imbalances between oil exporters and oil importers were reduced significantly, as OPEC's current account surplus was cut in half to 32 billion. That was thanks to reflected higher import propensity by OPEC than most forecasters had estimated. That's because the oil exporting countries embarked on numerous projects to build infrastructure. During this time, the oil importing developing countries were able to maintain reasonably strong growth throughout this period. That is because for two reasons. First, the favorable environment for commodity prices enabled them to enjoy strong export growth. Second, they benefited from positive resource transfers from abroad as a result of large capital inflows. So, ultimately, when the policymakers of the major industrial countries convened at Rambouillet, France, for their first economic summit, they could breathe a sign of relief that recycling of petrodollars through the world's financial system proceeded much more smoothly than they had ever imagined. While a few developing countries were candidates for debt rescheduling, there were really no major defaults to rock the world's financial system. So, after a brief period of infamous turmoil, the global economy enjoyed a period of resurgent economic growth while inflation rates and interest rates trended lower. Investors and policymakers quietly were hopeful that the turbulence of the first half of the 1970s was past and the global economy could enjoy a more tranquil period ahead. During this time in the United States, there was also a renewed sense of optimism that the Vietnam War would subside. Even though the war ended and the things in the world were moving steadily, however, the calm in the financial markets did not last very long. Largely because of a second oil shock and also because of the depreciation of the dollar. But that is a story to be told in a different video. If you like this video, please leave a like and a comment. Make sure to subscribe and hit the notification bell to know when the next video comes out.